Good morning and welcome to today's webinar brought to you by Antipodes. I'm Matt Dell from Pinnacle Investment Management, the distribution partner for Antipodes. Today's presentation is brought to you by Chris Connelly. Chris is a senior investment analyst and the sector leader for industrials and commodities. Prior to joining Antipodes Partners in 2015, he was an investment analyst at Platinum Asset Management for 6 years, where he covered a diverse range of sectors and geographies. Today we're talking about a stock that has been very prominent in the news in recent times, General Electric. A fallen giant, 60% off its 2-year high, but which is being restructured and now offers great value for investors. Over to you, Chris.
Thanks, Matt, and hi everyone. Welcome to Antipodes' presentation on GE. Just start on slide 2, and for a quick introduction for any new listeners, Antipodes is a pragmatic value of global long-short and long-only strategies. We take a holistic approach to investing, combining cyclical, structural, and macro considerations. We look to marry quantitative-based tools and processes with the qualitative insights that comes from a diverse and experienced global investment team. And most importantly, portfolio construction is core to our process. Managing money is not just about picking good stocks. It's also about managing overall risk in the portfolio. Ultimately, we aspire to generate absolute returns in excess of the benchmark over the investment cycle at below levels of market risk. Just move on to slide 3, and really that kind of outlines our philosophy. And really with every investment we look at, there are 3 important considerations. Firstly, the margin of safety or the price that you pay. How underwritten is this investment from a valuation perspective? Within the context of our valuation framework, we're looking for generate a minimum 15% absolute annual returns and at least 10% better than the relevant sector. Secondly, how is that valuation discount going to be unlocked? And for us, we always talk about multiple ways of winning. For every investment, we want there to be multiple ways that value can be realized. I think if you put it another way, we don't want there to be a single point of failure to the investment case. And then thirdly, what is the context within the existing portfolio? As much as we like to have correlated returns, we don't want too much correlated risk. Therefore, where there's a group of stocks that exhibit similarities in terms of their customers, product offering, macro sensitivities, etc., how the alpha is going to be generated, then we group those stocks into clusters, and we'll limit those clusters at no more than 15% of the portfolio. And then moving on to slide 4, and a bit of comic relief. But really, the image I think tells its own story, really about the distorting effect that a kind of a decade of extreme monetary policy has had on asset prices. It also actually, is a good segue into the next few slides, where we discuss some of the symptoms of extreme policy, and some of our observation of markets. And on slide 5, what we're showing here that is over most periods of history, the yield on the 10-year bond has been a function of inflation and real GDP growth. Can I put it another way? Holders of 10-year paper have typically been compensated for inflation and consumption foregone. That's obviously not the case now. Certainly in Eurozone and Japan, where bond prices are discounting a steep deceleration in growth and inflation. We don't actually think that is the case, but these yields are simply a function of such a long period of kind of accommodative monetary policy. We're in the look to the US as growth remains robust and inflation starts to pick up. We're actually starting to see a pretty significant rise in rates, and that's really accelerated actually in recent weeks. And we think if that's to continue, you could sort of see a material change of regime and leadership in stock markets. So moving on to slide 6, and we're kind of here we're sort of highlighting some of the imbalances we see in markets, certainly in terms of style factors. So what we've done here is for each factor we have measured the valuation of the top quintile of stocks relative to the bottom quintile, and we can look to see how that's changed over the past two decades. And we've then expressed that relative valuation today as a Z-score or standard deviation, from historical trend. So, in simple terms, what we're showing here is that growth as a factor, as expensive as it's ever been. Now, that's not just confined really to the tech sector, as it kind of largely was in the dot-com bubble, but it's pretty pervasive across all sectors. I guess given how suppressed rates are, it probably isn't surprising that investors have been willing to reach for future growth. I mean, the opportunity cost of doing so is so artificially low. I guess what we're also observing here is that profitability, or what most investors refer to as quality, is also very expensive. Obviously in this period of, I guess, macro and geopolitical uncertainty, investors are willing to pay a very high price for perceived certainty. And on slide 7, we're kind of showing a similar thing to the previous slide. This time we're just looking at on a sector basis rather than a style basis. But again, the outcome is very similar around the market's willingness to really pay up for quality. You can see that the market's largely herding into those more global and perceived stable sectors at the expense of kind of more cyclical domestic-facing businesses, i.e., telcos and financials, which obviously look very cheap relative to their history. So that gives you, I guess, a good framework of where we see markets today. But if we move on to slide 8, we can get into the focus of today's presentation, which is discussing our investment in General Electric, or more commonly known as GE. But to start with, let's kind of cast our minds back in history a bit, back to sort of 26th of June this year, which for GE was likely remembered as a hugely significant day. That day, GE was removed from the Dow Jones after 120 years of continuous membership. Indeed, it was the last remaining of the 12 original constituents of the Dow. The symbolic blow really crowned the end to a pretty underwhelming 24 months for GE, over which period the shares have lost more than 60% of the value. What was a far more important event that day was the announcement by the management team of their plan for restoring credibility and realising the significant value in the GE portfolio. Having spent a year studying the available options, management settled on a breakup plan, slimming the company down to a portfolio centred on GE Aviation, for us the jewel in GE's crown. Since that point, we have had a change in management with Larry Culp, the highly respected former CEO of Danaher, succeeding John Flannery as chairman and CEO. Mr. Culp is the first outsider to lead the company, and we view his appointment positively. We think he is the right man to pursue the strategy laid out by his predecessor, albeit probably with a greater urgency, but no doubt the same operational excellence which was a hallmark of his time at Danaher. We believe in the plan and the management team, and we see this year as significantly undervalued at the current levels. To slide 9, and I guess the question is, what exactly went wrong at GE? Ultimately, for us, we see it as a combination really of three factors. Firstly, historically very poor capital allocation. A large downturn in the market for power equipment, and thirdly, the burden of their legacy insurance business. As a consequence of this, GE now carries too much debt, has suffered from significant earnings downgrade in the power business, and has had to take meaningful charges against its legacy insurance liabilities. Having gone to kind of great lengths to understand each of these, we believe the point of maximum pain has passed. As we move on to slide 10, I think make the point that what's been lost in the current share price malaise is the strength of the business that inside the conglomerate, most notably aviation and healthcare, which are assets where the bulk of the value lie. These are leadership businesses with high barriers to entry and structurally growing industries. The kind of businesses we look for Antipodes, and it's rare to find such assets trading at such lowly valuation compared to peers. At the core of GE's plan is the intention to monetize part of the healthcare business and divest the majority holdings at Baker Hughes, with these actions reducing the debt burden to a more sustainable level. At the end of the process, as the slides show, GE will comprise of 3 divisions compared to the current 7. That is aviation, power, and renewables. Management will also cut corporate costs and further reduce the size of GE Capital. At the heart of what is left will be the aviation business, the quality of which is obscured by the travails of the broader group. But on to slide 11, and before we look at some of the operating business at GE, let's just consider the management and organizational changes that are happening at this company. Historically, GE has been an organization with a very powerful central function which took decisions on behalf of the various operating divisions. As a consequence, we had a remuneration policy that was too closely tied to group rather than divisional performance, and capital allocation that was both prescriptive and questionable. The management's plan is resolved to dismantle a large part of these central functions whilst also increasing divisional autonomy. Combined with a change in remuneration policy that increases both the focus on divisional results and cash flow, we believe the outcome will be a behaviour that's far more aligned with minority shareholders' interest. Obviously, since the initial plan was announced, Larry Culp has succeeded John Flannery as chairman and CEO. And we think the change is the right one. John Flannery was the architect of the plan, but Larry Culp is the man to execute it. However, it's not like Larry's new to the plan. After all, he was part of the board that helped Flannery craft it in the first place. It's a bit of history. Larry Culp ran Danaher for 14 years from the start of the millennium. And the increase in the share price over that time, I think, accurately reflects the value that he created at that organisation. If you take the quote from the top of the page, "Common sense, vigorously applied." This was the mantra that Larry installed at Danaher, and it's something that we expect him to repeat at GE. So moving on to slide 12, and we talk about GE Aviation. And what is it we like so much about the aviation business? Firstly, let's just consider the industry. Make no mistake about it, this is a structurally growing industry. Over the long term, commercial aviation industry has grown approximately 1.5 times GDP, with that growth visible both in developed and emerging markets. What's been the driver? Increasing affluence, rising propensity to travel, but most importantly, a persistently declining cost of flying. And as that last point, the decline in the cost of flying, the engine makers like GE have been instrumental in delivering to the airline industry. So each generation of new engines delivered a marked improvement in fuel efficiency over the prior. As fuel is likely to remain the largest cost for airline, the return on innovation remains high, and technology leadership should remain sustainable. So this constant innovation of engines helped to force a kind of natural upgrade cycle as airlines seek to remain competitive in fuel efficiency, a dynamic which is only likely to intensify in high oil price environments. As we turn to the next slide, we can see that the development of jet engines is a highly consolidated industry and one that GE dominates. GE's jet business powers either directly or through their CFM joint venture with Safran 70% of the world's operating fleet of narrow-body planes and nearly 50% of the world's fleet of wide-body planes. Booked orders point to market shares sort of persisting at that level well into the future. For GE, their presence across the thrust range represents a significant scale advantage in manufacturing costs and breadth of customer offering. Looking at the kind of the dynamics in the industry, the practices for the initial sale of an engine, it happens either a low margin or a loss. However, the engine makers extract the returns as those engines are overhauled and parts replaced throughout their operating life, which for most of these engines is well over 30 years. For GE, the majority of the engines that they sell have an associated service agreement with them, which gives them a contractual lock over highly profitable sale of future spares over that multi-decade time frame. And even for those engines that are sold without a contract, customers have little incentive or ability to source alternatives. Kind of put simply, every engine delivered today has significant future earnings attached to it that they're certainly not reflected in current financials or indeed in the valuation of this business. What about slide 14? What about the other parts of GE? As I said earlier, the common feature of most of GE's businesses tend to be that they're market leaders in industries that are structurally growing, where there's high barriers to entry, and a high proportion of revenue coming from highly profitable aftermarket sales. And while most of these businesses are executing well in strong markets, the power business is facing a severe industry downturn. Most notably in the market for large gas turbines. And that's really what's kind of got, despite being a small part of the portfolio, that's actually what's gathered most of the market's attention. But good things are still happening in this industry. Obviously in response to downturn, capacity and capital has been withdrawn from the sector. Meanwhile, the utilization of the existing fleet is actually rising, suggesting better times ahead, even if there's no immediate volume recovery. The market appears convinced that the downturn in demand is structural rather than cyclical. Assertion which we strongly disagree with. We actually believe there is a positive long-term structural outlook for this business. And really, as global attempts to decarbonize gather pace, we see it's almost inevitable that gas power generation displaces coal plants as baseload power. Indeed, for all the negativity that kind of currently exists around gas turbines in the US, it's interesting to note that this year the additions to the natural gas fired power generation capacity will be the largest since 2004, and substantially more capacity is set to come online through 2021. As we have outlined on numerous occasions, for us, natural gas is the fossil generation fuel source of the future, and for us, GE has a very compelling offering. So on to kind of slide 15, and we start to talk around, I guess, valuation. And while it kind of GE currently represents a pretty complex asset, the management team, as I said, is focused on simplifying that structure, and I guess realizing the value inherent in the portfolio. And at the end of that kind of disposal process, this is going to be a business which we estimate will drive more than 70% of its profits from aviation. An industry where the median valuation of industry, the valuation of peers is around 14 times EV to EBIT, whereas in our estimates we think GE could be trading as little as 9 times next year. This is just one way to value GE. However, we believe it looks materially undervalued on nearly every metric. As the table implies, if we assume no further contributions to the insurance business beyond those already announced, we think we can justify the current share price with the aviation and healthcare divisions alone. By implication, the current price. At the current price, the market is discounting all of the other assets, so the power, Baker Hughes, renewable, transport, lighting, capital, are either worthless or consumed by those insurance liability. Obviously, we can't categorically say that is not the case, but to us, the risk reward looks incredibly favourable. And so on our sum of the parts, we estimate fair value is at least $19 per share compared to the current price of just over 13. To slide 16, we talk about kind of risk reward, and as with any investment, GE doesn't come without risk. The bullet points on the slide clearly highlight some of those potential risks. And while we acknowledge them, we do think that they're more than fully priced into the shares. That one area that the market's particularly concerned about is the exposure to long-term care insurance. Even though GE hasn't written insurance policies in 2006, obviously it is still continues to suffer the impacts of that pre-existing book of business. Obviously, the culmination of this came last year when the company took an after-tax charge of $6 billion and agreed to contribute a further $15 billion of capital over the next 7 years to rebuild that reserve base. Management, asserts that they're now well reserved, a claim which the available information and certainly all our research well supports. Having said that, management are exploring the possibility of moving the liabilities off GE's balance sheet. And from the share price, it's clear that the market believes the cost of such move would be exorbitant and doubts even possible. But look, this is a well-reserved block of where liabilities have potentially been marked. It's probably what's going to be the low point of the global rate cycle. We certainly don't believe that resolving this issue will be anywhere near as expensive as the market fears. And at the end of the day, you must forget this is a business that is positively geared to higher rates, which will have to act to diminish those future liabilities. Anyways, to get to the next slide, it's worth just putting the valuation of GE in context with peers within this sector. On our from the quant tool here, we're showing that the businesses within GE, if separate, would trade at certainly much higher multiples if they were certainly listed. Developed in the developed world, aerospace and defense companies are really the most expensive that they've ever been relative to their history. Interestingly, North American industrial conglomerates, obviously which GE is one of the largest, are trading at some of the cheapest multiples relative to history. So buying GE today clearly represents a very inexpensive route to a very, very highly valued sector. The discrepancy, obviously, which we think will close as the breakup proceeds. And certainly in a market that is prepared to pay a very high valuation multiple for structural growth, our investment in GE, we think represents a remarkably cheap way of gaining exposure to such a style factor. For us, we think that this could represent a potential style tailwind that should accelerate a re-rating of the company, assuming our kind of fundamental case is sound. So that sort of brings the end of the discussion around GE, and I think just to kind of conclude a few points, I just want to hit home really on markets. Obviously, I think investors are significantly overpaying for growth. We're focusing on that next crop of winners in the neglected areas, but encouragingly for us, multiple dispersion is very high. So I think there's numerous attractive opportunities for bottom-up stock pickers, both on the long and the short side. But that concludes my remarks, and so I'll hand back over to Matt to conclude.
Thank you, Chris. And just a few comments about performance. Pleasingly, all three Antipodes funds have comfortably beaten their benchmarks from inception in July 2015 to the 30th of September. Just on slide 18, the Global Long Short Fund in particular has achieved this whilst being defensively positioned, on average only 59% net exposed to the market. Also pleasing is the upside-downside capture, where for the Long Short Fund, investors have gained nearly all the upside, 94%, and less than half the downside, 48%, which is an important statistic in a very mature bull market. We also have a few slides on pages 19, 20 and 21 there on current alpha clusters and portfolio positioning. Speaking of the LIC, the outstanding options are currently in the money and expire next Monday, the 15th of October. The stock is currently trading around $1.15. The options are exercisable at $1.10, so you may wish to discuss this with your clients that have options in the company. For those of you seeking alternative structures for your clients, I'm pleased to advise that we'll be launching an exchange-quoted managed fund or an active ETF on the 22nd of October this year. That is, it's an open-ended unit trust, actively managed, listed on the ASX, and that will provide access to the Antipodes Global Long Strategy. And finally, a member of the Pinnacle distribution team is available to provide further information if you'd like on Antipodes, or you can just visit antipodespartners.com. I'm required to show you the disclaimers, so there they are. And that concludes today's webinar. Thank you for dialing in and for your support of Antipodes, and I hope you have a good day.